when we talk of international trade, we must always think about how do we secure our payments as suppliers. So our suppliers, how do we ensure that the people that we supply these goods to, who are in a different country, how are they going to pay us? In international trade, there is a lot of conmanship. People end up losing their merchandise to buyers who are in different countries at a very high rate. So you can imagine, for example, if you got a buyer today, you happen to be an international trader, you got a buyer today who is based in Nigeria. What do you think in this case is the risk of you being conned by this Nigerian? All right. What do you think is the risk percentage of you being conned by this? If you're not careful, there is a very high risk, like say 90%, very high, of you being conned. So you must look for a way of securing your payment. And one of those ways, of course, is to ask for what we call a letter of credit. A letter of credit from reputable banks, from reputable banks, from reputable international banks, from reputable international banks. So like now what we do ourselves here where I work, I remember like there was this scenario where we got a very big telecommunications company in Iraq. But we are really fearing, this is a country which is really in big war, right? How will this person be able to do what he pay us after we deploy the system, right? Our licenses are quite huge. They're about 50 million Kenya shillings per annum, right? So then what we did, we asked that particular company to give us a letter of credit from a reputable international institution here, bank. So the letter of credit basically means what? Yeah, that the bank takes an undertaking. The bank gives us an undertaking that they will pay us, right? Right? Upon fulfillment of certain obligations from our side, the bank undertakes to pay us. So it's like we are no longer dealing with this particular company that we do not know. Now we are dealing with a bank that is renowned. Once in this case, they give us certain undertaking, now we are comfortable, we can very comfortably deploy our system to who? To this company, which now is based in whichever country. So this is very important. Once I get this letter of credit from a reputable bank, then automatically I'm safe now. I'm safe now. This is very good. Number two is to ask for prepayments. Tell those guys the truth. Tell them that we fear you. We fear you. So now that we fear you, is it possible for you to give us payments in advance? So we ask for what we call prepayments. This is very important. Prepayments, pay us in advance, right? Of course, there is nothing to be explained there. Ladies and gentlemen, we could also, in this case here, ask for what we call a bill of exchange. Bill of exchange, bill of exchange, bills of exchange. Bills of exchange. So under bills of exchange, this is pretty much similar to letter of credit. However, it is not drawn by a bank this time around. This is drawn by who? This is drawn by who? This is drawn by the exporter, the supplier. So it comes straight away to me. There are two types of bills of credit. They're also called drafts. So there are two types of drafts here. We have number one, what we call the site credit. What we call the site credit, or that site draft. So site draft, of course, the moment, in this case here, this consignment reaches us, the moment we have these shipped goods reaching us, on top there we can see some draft. If the draft is a site, upon you confirming that everything is okay with your eyes, site draft means that you need to pay us upon you getting your goods. It's a site draft. It's a bill of exchange. Right? Although you can see the risk is very high, there are people who will see those things like this. They see the draft like this, and then they fail to honor, right? And then, of course, we have what we call a time draft, depending on the credit arrangement that we have. Depending on the credit arrangement that we have, ladies and gentlemen, we could have a situation where you get your goods, and then we request you, we order you to pay us, say, in 30 days, 2 months. So we call that particular bill of exchange, which is time-based payment, a time draft, a time draft, a time draft, a time draft. Ladies and gentlemen, we could also organize like consignments. I've seen these things happening where I work severally because we are in 140 countries. We're in 140 countries. So at times in this case here, to be very secure, what we do, to be very secure, what we do, we organize what we call consignments. Consignments. So consignment, and a consignment will go to a good country. Like, for example, we normally do this a lot in South Africa. So in South Africa, of course, we have some people who are serious distributors of software products here, software vendors. So then what we shall do, we shall go there and give them our, what do we call them? You know, like how people host softwares in the cloud. We have these physical hosting systems. We provide both physical and what here, these cloud services. So with these physical hardware devices, so what we shall do, we shall organize with these software vendors. We give them these physical, they're like computers, but very expensive. We give them like, say, 5 of them on a consignment basis. Consignment basis means what? That these particular assets, the ownership does not transfer to anyone else. The ownership remains with who? The seller. The title of these particular goods there remains with the seller. So in this case here, the title still is ours as Arrow. We don't, in this case here, transfer these goods to the vendors, right? They're still ours. So then somebody will ask ourselves here, how do we ensure that at the end of the day, this person, the distributor, does not sell these goods, and then they do what here, and then they disappear with our money? What we shall do, these goods are ours. First of all, the vendors that we deal with, we will vet them. We vet them so seriously. And once we recognize that, of course, they have been there for quite a long time, they've got financial muscle, etc. Now we are organizing with them some kind of a financing deal called consignment, where basically they'll sell and they get a commission out of their sales, right? What we shall do is also to look for an international insurance company. And of course, in this case here, insure these particular goods comprehensively. So should they disappear, so basically we are transferring the risk to the insurance company. We are transferring the risk to the insurance company. So ladies and gentlemen, you may forget about so many things, but please don't forget about letters of credit given by the banks. We have bills of exchange given by what here? The suppliers. We have, in this case here, this kind of what we have called what here? Consignment. Consignment, we're giving away our goods. So those people are basically acting like they're storing those goods on our behalf and selling them on our behalf. Should they sell, of course, we shall be able to give them what here? Some commission. They're serious distributors. Some commission. Yes, very important. Now, ladies and gentlemen, of course, then we have what we call the open accounts, especially once we get used to each other. We can have an open account, especially when you are dealing with Muslims. It's like most Muslims are very honest. When they tell them we have an open account, you guys will be paying like after 30 days. Most of them will tend to do what you have to honor. As Christians, at times we are not very honest. True or false? True or false? Debate for another day. 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 Running an open account with somebody who is in a different country can be what here? Can be so risky. Then now, ladies and gentlemen, here we are. We have gotten a business of say 50 million Kenya shillings, an international business of 50 million Kenya shillings, right? So this business that we have gotten, we have this particular buyer who has made a promise. He'll be giving us this 50 million, right? So in my books, I can even go ahead and give him the goods. I've given him the goods. So in my books, I have a receivable. I have a receivable of 50 million from who? From, in this case here, Lucy, who in this case here we shall assume is a Tanzanian, who in this case here we have done business with, and she'll be giving me 50 million Kenya. So, you know, the moment I make this delivery, I'll be cash strapped. I'll be cash constrained. So then one of the ways of, building up my finances back is, for example, to do what we call factoring of receivables. Factoring of receivables is one unique way of now financing. How do you finance international trade? Financing of international trade. Financing of international trade. Financing of international trade. Once you've been able to, in this case here, sell goods on credit to somebody who is outside there, you could go under number one, do what we call factoring. Factoring of receivables. Factoring of receivables. I've seen this happening. Like I've told you, we're in 150 countries. We are doing big business. And of course, I expect us to be running, of course, low on funds. Right? So then what I'll normally see them doing, these people will go through the balance sheet of the company. They'll be able to identify receivables. Receivables that they sell to a bank. They go and tell the bank, I have this receivable from Lucy, but I would want to factor it out. Factoring means selling. So you sell the receivable to the bank. So in this case here, Lucy will get an email and whatever contract documents that when it comes to paying this particular money, pay this particular money to LCBA bank, this account by this date. So we factor. So once we have factored, we have sold this particular receipt. Of course, it will not be only for one person. I'm using Lucy here because this is just a simple example. You can't factor only one. You factor like even 100 of them. You sold those receivables. You factored them out. You factored them out. So what the bank will do, the bank will give you, the bank will, you know, the bank is buying. So if the receivables are receivables of 50 million, the bank will, for the risk it is taking, the bank will give you like 30 million upfront. And then now they wait like that. They wait perhaps at the end of the month. And then Lucy pays. What do you think will happen if Lucy doesn't pay? If Lucy doesn't pay this bank, what do you think will happen? If Lucy doesn't pay the money to the bank, if Lucy in this case here decides to be like Murife and she runs away, what do you think in this case here will happen? What do you think will happen? Insurance company, we have got two types of factoring. We have a factoring with recourse. Factoring with recourse. Factoring with recourse and factoring without recourse. Without recourse. So without recourse means that if the bank is not able to collect this money from Lucy, they can't come back to me. They go away. They die. They go dying. They go drying. They go like that. That is factoring without recourse. You don't go back to the person, in this case here, who sold the receivables to you. That's factoring without recourse. So the bank takes a higher risk. But again, remember, they're also very bright. When they take such kind of a higher risk, it means that the bank's returns must be very high. So the bank can even ask you for a 60% discount because of the risk they're taking. Right? And then now we have, in this case here, factoring with recourse. So for factoring with recourse, should I call Lucy day number one? I get Lucy is Muteja day one. Another day, Lucy is Muteja. So meaning that Lucy is not able to pay me. And that period that given, the grace period given has already passed. What do? I'll go back to the person who factored this receivable to me, tell them, hey, this person has not paid. Follow the person. I'm giving you 30 days. Should you fail in this case here to pay, I'm coming back for my 30 million. So factoring, very important. It's one of the ways that in this case here you could use in this case here to do what here to raise finances. Number two, listen here. Number two, we have these letters of credit and the bills of exchange. The same thing, letters of credit, stroke bills of what year? Bills of exchange. So these are promissory notes that you have. Somebody like a bank has told you, we shall pay you in 90 days. So once you have a letter of credit, you can go ahead and get cash out of that letter of credit, either from the same bank that issued that letter of credit to you, or even from any other bank. So you'll go and carry out what we call discounting, just like you've had people discount checks. I want to raise money, and I have a letter of credit here from a reputable institution. So if it's KCB, I'll go to KCB, tell KCB, you know what? Even if you told me that you guys are going to pay me after 60 days, I cannot wait. I've got other deliveries that I would want to make. Life must go on. So is it possible we discount this? So instead of giving me 50 million after 3 months, let's work it out. Give me 35 million today. I stand to lose in this case here 15 million in the process because that will be the bank's commission. But at the end of the day, you know, at times you could be cash strapped in a way that even your going concern may be under threat. So you'd rather, in this case here, you do discounting over any bills of exchange you have, any letters of credit that you have, in a way that you are able to get some money at, or rather like today, in advance, albeit at what year? At some heavy discount, Great. Ladies and gentlemen, at the same time, in this case here, you could go and sell. You can convert. You can decide here to convert these letters of credit to what we call derivatives. Derivatives exchange is like a stock exchange, where you can go and tell people, you know what, I would rather transfer this thing to you. Give me this money. And once you give me this money, then I will be able to do what here? I'll be able to survive. All right. The most important thing that I would want to sell to you here tonight is that in international finance, when we are looking at how do I finance this thing, of course, there are so many ways, like the ones of factoring. Right? You've been given an invoice. If you've been given an invoice, you can also approach your bank, and your bank will be able to give you money against what here that invoice to do what here to do your supplies, of course, upon them carrying out what we call due diligence. So I hope you've been able to take your notes in a high level, in a way that when you go to an exam and then they mention something, you can't really come out of that particular exam, out of doing that exam question with 0 marks. You should be able to have an idea. Now, ladies and gentlemen, listen to me very well. Still under international finance, we have what we call dividend policy, which is a very short area. Dividend policy of multinationals, policy of multinational companies. Dividend policy of multinational companies. So first of all, it will be very important for us to know that multinational companies are those companies, excuse me, I'm seeing so many charts here, I wasn't concentrating, just give me 1 minute. Derivatives, great. And derivatives is actually it's our next topic. You'll be able to understand this concept of derivatives better when we take on the next topic called financial risk management. Great. Thank you. So when we talk of a multinational, this is a company that has got branches or subsidiaries in many nations. So we have, for example, EABL. EABL has its headquarters where? Here in Kenya. EABL has quite a big presence now in Uganda. EABL has acquired Serengeti breweries in Tanzania. So basically, it has got presence. And remember, if you, for example, you go to some countries like South Africa, even the UK, right? You'll be able to get some brands, especially Tusker, belonging to EABL. So they have got operations in many nations. Now, when it comes to dividend policy, we have got two types of policies here. Remember dividends, we are giving dividends to who? To the owners of the business. Those people have got shares, right? So in this case here, you will need a dividend policy, you will need a dividend policy for who? For external shareholders. For external shareholders. And then of course you'll need a dividend policy here, for who? A dividend policy here for parent companies. The subsidiaries must always pay dividends to the owners, called who? Parent companies. Dividend policy for parent companies. Ladies and gentlemen, the most important thing that you're supposed to pick out of this is that dividend policy has to be something that inspires the whole world to look upon your organization positively. There is no way you will ever have a dividend policy of a multinational being one that sees the investors losing value, losing funds. We always recommend what we call a stable dividend policy. So we normally recommend here for multinationals, we would want them to give what we call a stable dividend policy, to have a stable dividend. What is a stable dividend policy? When we talk of stable, ladies and gentlemen, basically it's called stable because whatever dividend you're going to be paying, is normally predetermined, can be determined in advance. It's predetermined. In most cases, it's straight line. It is straight line. If you look at, for example, the dividend policy of Safaricom, you will see that if, for example, they gave, say, 10 cents in year one, they'll strive to ensure that the bare minimum come to year 2 will be 10. But interestingly, it should be around what year? 11. So like if it's 10% increase, 10%, they really strive to ensure that they follow that, right? So dividend policy should be what here? Should be stable. The external investors here should be able to predict in advance and know what they expect. They don't want excuses. They don't want to be told at the end of the day that, you know what, this is COVID-19 duration. They don't want to hear that. Them in this case here, they made an investment. It is you as a blue chip. Most of these multinational companies are blue chip companies. They are blue chip companies. So these guys would not want to what here? An excuse. Blue chip companies are supposed to shine. And they only get to shine when they are able to pay stable dividends in rather against hostile economic water conditions. So you're saying something very important, ladies and gentlemen. Remember, we are using these dividends to signal to the market, to tell the market that, hey, this company is good. Most of these multinational companies, like the one that I work for sure I know, because of rapid expansion, these guys are normally cash strapped. They are all over. That is why they do cross-listing. They are cross-listed in Sweden. They are cross-listed in UK, like now Kenya Airways. It is cross-listed here in Nairobi Stock Exchange. It has also done some cross. Cross means beyond, over and above, beyond your country's territory. So it's also cross-listed in Uganda Stock Exchange because they would want to raise funds. I mean, you know, this is what we call overtrading. They're growing at a speed that they can't sustain. That's the concept of being a multinational, right? Like now KQ, a small entity that has got about 20 aircraft. It wants to flow all over the world. So how does it survive? Through borrowing. And for it to be able to borrow, then they have to be seen to be credible by investors. That is why you get like most of these multinational companies would rather do anything to ensure that their share price is growing, because they would want their shares to be always highly demanded. When the shares of a company are highly demanded, it becomes quite easy for them to raise capital, even if it is in the secondary market. So under the dividend policy, ladies and gentlemen, of multinationals, we are saying here that we must ensure that the dividend, both for our parent companies, for whoever owns us, the dividend policy must always be what here? Must be stable. Must be stable. Must be stable. So stable means what here? That the dividend we're going to receive must be predetermined. Must be something that you can know in advance. You know, there are companies that are very fake. Like now, if, for example, you are here and you happen to be having shares in Uchumi, shares in this case that were removed out of the shelves of Nairobi stock, they can't be seen. You can't buy, you can't sell any shares of Uchumi stock or Uchumi supermarket. So if, for example, you have Uchumi's shares, do you know when next you will start really getting dividends? No. The same case with Eveready, Paka Power. The same case with the Kenya Airways. These are fake investments. So you can't talk of stability in them. Their dividends cannot be what? Cannot be stable, right? Right? So for multinationals, for them to be able to keep on raising funds, and their, as I've told you, their appetite for getting loans and of course raising capital is very high. For you to be able to do that, ensure that the dividends policy is very stable, very stable. People would want dividends for them to keep on buying your shares. Every time you float any shareholding, there are people who are willing to do what to pay. When you come and tell these people, hey, you know what? Want to raise more money? Want to raise more money through a rights issue? Through a rights issue. Remember, rights issue, these are shares you're giving to existing shareholders at a very discounted price, right? If your company doesn't pay stable dividends, even if you tell them that you're going to sell to them a share worth 10 bob, but now you're promising to sell to them the same share at 1 shilling, deeply discounted. Rights issues. If your dividends are not stable, people will not subscribe to them. People will say it's an option, let it stay. I don't want. So for multinationals, because of what I've told you, that these guys, for their survival, they really need money out from outside here, then they must ensure that their dividends are what here? They're very, very stable. Now listen and listen to me very well. Now, especially when we are looking at now what we call dividend repatriation. You know, you're looking at parent versus subsidiaries. Now you're trying to look at a situation where this company that is based in Nigeria has made profits. Out of these profits, they're supposed to pay what? They're supposed to pay dividends. But Nigeria is restricting this particular subsidiary to pay dividends, in this case here, to a parent company, which is based in Kenya. Perhaps Kenya to Nigeria, it's viewed as an enemy country. So they have said, any business that you're doing here that is owned by Kenyans, don't pay dividends. Don't pay dividends to the parent companies. Nothing. Let them consume that money where? In Nigeria. We don't want to fight them, but what we want is them to come over here and then they eat all their profits here. So they can keep on expanding in Nigeria, but they can never repatriate these dividends. Ladies and gentlemen, whenever we talk of dividend policy for multinationals, we must always think about what we call transfer pricing. Transfer pricing. Transfer pricing. Very important, please mention there. Transfer pricing. Transfer pricing. Transfer pricing. Now remember, initially, I don't want to get into the nitty-gritties of this. Initially, we used to have something like this. We used to have something like this. Two departments of the same organization. Perhaps this was a manufacturing department and this was a selling department. What used to happen, the manufacturing department here could produce, for example, chairs. If it's a chair manufacturing company, they would produce these chairs and then they would, in this case here, transfer all the chairs to the selling department for free. For free. For free. Listen, ladies and gentlemen, here. People came and discovered that if this is transferring these chairs to the next department for free, then this department is landlocked. It doesn't have any revenues, right? So the only thing you can use to appraise their performance is just the cost of production. And then now here they were going to the annual general meeting. And in the annual general meeting, The shareholders never wanted to hear of anything else other than profits in the AGM. In the AGM, it was only profit and profit and profit, nothing else, because they knew for sure that it's out of profits that they would get, in this case, dividends. If profits were high, then dividends would be high. So then people sat down and they thought, I mean, how would we make everybody in the organization profit conscious? Then they discovered that the only way is to make all departments profit centers. Profit centers. Now, ladies and gentlemen, please listen here. How do we normally get profit of a company? To get profit, we normally take revenues minus cost. To get profit, we normally take revenues minus cost. So they said, for us to be able to have this manufacturing department raising its own revenues, of course, they don't have external customers. So the only way out is to have the selling department paying for the goods it is receiving from the manufacturing, paying. So, ladies and gentlemen, when we talk over a transfer price, this is basically the value of goods that are being transferred from one department to another department of the same organization. That valuation, the value of goods, the price that you pay for internally transferred goods. Goods have been transferred internally, but you're being told here to pay a price. That price that you pay for internal transfers is what we call a transfer price. Now listen, this is very interesting. Why in this case here is transfer pricing very relevant and connected to this very important subtopic that we are studying here today. Now, when we talk of objectives of transfer pricing, what are the objectives of transfer pricing? What are the objectives of transfer pricing? I'll be able to give you several objectives of transfer pricing. Listen here. Objectives of transfer pricing. Objectives of transfer pricing. I'll not give you objectives of transfer pricing in the context of advanced management accounting. I'm looking at the objectives of transfer pricing in the context of AFM, right? Dividends of multinational companies. The first objective then would be, number one here, to minimize global taxes. This means profits shall increase. Profits shall increase. Profits of the multinational, profit of the multinational company shall do what here? Shall increase. And when profits increase, of course, we appreciate the fact that then dividends will go up. Dividends will go up. To minimize global taxes. How do we play around with this transfer pricing to boost our profits and therefore boosting our dividends? It's very easy. What we shall do, ladies and gentlemen, is to have, and this is something that I'm really hoping for and praying that to my God to assist me to achieve this. So we have a college in Kenya here. For us to be able to enjoy, of course, we know that taxes in Kenya are quite heavy, and we know that tax avoidance is not a criminal thing. It's very much allowed. So in this case here, I should be able to, after some time, open, in this case, a management office. I'll say that the entire RCM Online College is being managed from a branch of ours, not a branch, but we have got a management office in Cayman Islands. So this is Kenya, RCM is here, but the management office, we have, in this case here, done what here? We have outsourced this to a company which is in one of these tax havens, like Cayman Islands, like Mauritius, etc., tax havens. Those countries whose rates of tax are zero, if not negative. At times, these guys will tell you, come and have a setup here, tax holiday, 20 years, and for machinery you bring around, we shall be able to give you crazy waivers. They're basically incentivizing you to ensure that you come over here, because they have discovered that the biggest problem that is destroying those countries is unemployment. And they know that the moment we have everybody employed, right, Now the money that they would have gotten as taxes from these investors will be realized from the employees in form of payee. So the payee is at 50%, very high, 50%. But you see, nobody will care about that high payee. Why? Because taxes are working for them. They're employed. So the happiness index in this case here goes up. That's what I want to teach you today. What I wanted to teach you today, ladies and gentlemen, is that now we have RCM here versus this management office, which of course belongs to RCM. But you see, Cayman Island cannot disclose who the owners of this management office is. That is one of the attributes of a tax haven. Secrecy. They can never tell anybody who the owners of this company is. Right? So then what we shall be doing is that we shall be coming right away to, at the end of the year, we shall be throwing invoices. We shall throw in an invoice here and ask RCM to pay us 30 million for a 12 months management service that we offered, 30 million. So it's an invoice, RCM honors, sends it here. Once this money enters there, no taxes on it. Now we can go to Cayman Islands, we swim a little bit here and there, and then now once we have those crazy dollars now from there, now we can be moving around the whole world, enjoying our money like that, right? So what have we done? That we have minimized our global taxes using what we call the transfer pricing system, using what we call the transfer pricing, where you shift your profits to tax havens, where you shift your profits to your branches that are in countries whose tax regimes are friendlier. So the essence here is that we would want to use the transfer price, it's a transfer price, to be able to do what here, somebody to minimize our taxes. Once we minimize our global taxes, then our global profit will be up there. And once our global profit is up there, then our global dividends will also be up there. So our investors will be happy. We shall be able to guarantee our investors stable dividends. Number two is the concept of what here, the second objective of this transfer pricing is dividend repatriation, dividend repatriation, dividend repatriation, dividend repatriation from who? From enemy countries. From enemy. So once in this case here, these particular countries here know that we have companies here that would want to pay their owners in Kenya dividends, they'll say, no, don't pay them. This money must be eaten around here in Nigeria. So the very best thing you need to do, ladies and gentlemen, is basically to have the Kenyan office invoicing the Nigerian office, telling them that there is some service that we offered to you. There's some goods we offered to you. If it's an invoice, it will be honored. But not a declaration of what you did, dividends. Not a declaration of dividends. Not a declaration of what year of dividends. So multinationals outside here, ladies and gentlemen, are really, really getting it rough in terms of how do we move our monies across the world. And that is why you get a profession in terms of transfer pricing right now. If you become a transfer pricing expert, you will be paid in millions. The transfer pricing experts we deal with where I work, those guys are crazily paid, lots of money. You can even do one job like this a whole year, and it pays all your expenses here for even 2-3 years. Transfer pricing, it's an area I would want you to consider doing. And of course, do the transfer pricing after you clear this. You can do transfer pricing. There is a body of transfer pricing which will give you a diploma like that. So that is it, ladies and gentlemen, as pertains to this particular topic. I just wanted you to have a high-level overview of this theory topic. We have got a few things here and there, like, for example, how to compute WACC of a multinational company. We have got what we call multinational companies, capital budgeting. Those ones will fall in their respective what year, their respective topics. Like there is a subtopic there called money market. We are going to deal with it in now this other topic that we are starting today, called who? Financial risk management. So please flip over the page there, and then you mention financial risk management. Financial risk management. Financial risk management. I think it's topic number 8. Financial risk management. Financial risk management. Financial risk management. So when you talk of financial risk management, again, we are looking at this from the angle of international finance. Now here, we are going to encounter quite a lot issues to do with foreign exchange. Foreign exchange. There'll be quite a lot of computations here under what we call foreign exchange. So it will be very important for you to mention subtitle there before I even do an introduction. Mention there exchange rates. Exchange rates. We understand first of all the exchange rate system. Exchange rates. Exchange rates, abracadabra. Tell us there that there are 2 types of exchange rates. 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 Great. Good question over there. Like now, arbitrage falls again here, like the triangular bit. It has a lot of what here? A lot of exchange rates. So if I teach it there, you'll not be able to pick it very well. These topics are very much connected. Actually, in most of the semesters, I've been teaching them as if they are one. Great. So there are 2 types of what here?